Have you ever actually stopped to wonder how insurance companies can boldly promise to pay out millions for completely unpredictable future disasters without, well, going totally broke themselves? I mean, really think about it. They're operating in a world where a massive hurricane, a sudden market crash, or just a huge wave of claims could happen at literally any second. So, how is your financial safety net actually guaranteed?
Well, welcome to this explainer. Today we're diving into some seriously fascinating research titled Optimal Surplus Management for Insurers Under Stochastic Interest Rates and Jump-Driven Liabilities. We are going to unpack the brilliant, almost hidden actuarial math that makes sure your insurance payouts actually happen. All right, let's jump right in and see exactly how the experts manage to keep the ship afloat when the financial storms hit. Here's our quick roadmap for today. We'll hit the insurer's dilemma, two sources of chaos, the math roadblock, the two-part solution, proof in the numbers, and finally wrap up with why this matters. Okay, Section 1, the insurer's dilemma. All right, I want you to picture a single dollar of an insurance company's surplus capital, kind of embarking on this hero's journey. Its whole mission is to survive highly uncertain markets, so it's actually there when a policyholder needs it. But it's not just sitting safe in some underground vault. An insurer has to perform this crazy high-wire balancing act. They're constantly dynamically splitting their capital between risky assets, like stocks for the growth they need, and totally safe assets, like risk-free zero-coupon bonds. They basically have to grow the pile of money and protect it at the exact same time. Moving right along to Section 2, two sources of chaos. Out there in the wild market, our heroic little surplus dollar faces two major villains that are constantly trying to wipe it out. First up, we've got stochastic interest rates. Think of this as continuous, unpredictable market volatility. Interest rates are just constantly fluctuating, entirely changing the value of those safe bonds and the expected returns of the market. And then we have our second villain, jump-driven liabilities. These are sudden, violent, rogue waves of massive insurance claims. Just imagine a natural disaster abruptly triggering thousands of payouts all at once. Take a look at this. This perfectly illustrates that first villain. It shows simulated pads of the Cox-Ingersoll-Ross, or CIR, short rate model. And just look at how completely chaotic those lines are. The interest rates are bouncing around wildly over a 10-year horizon. But do you see that dotted line running through the middle? That is the long-run mean. The interest rate acts kind of like a giant rubber band. It stretches up and down chaotically, but gravity, or, the math of mean reversion, is always pulling it right back toward the center. Trying to manage money through that constant pulling chaos is incredibly tough. Which brings us to Section 3, the math roadblock. So, to actually beat these villains, actuaries rely on the Hamilton-Jacobi-Bellman, or HJB, equation. But here's the catch. Because interest rate hedges and the insurer's surplus interact with each other, this equation blows up into a complete 3D nightmare. It's trying to track time, surplus, and interest rates all at once. And this interaction generates these really messy quadratic surplus terms. Long story short, finding an exact, perfect solution would require an infinite dimensional power series. Theoretically, it's pretty much impossible to solve perfectly in any sort of usable way. But the authors of this paper engineered an absolute game changer of a mathematical shortcut. They call it the normalized surplus projection. It's kind of like filtering out the static on a radio, so you can finally hear a crisp, clear signal. By evaluating the surplus at a baseline of 0, they essentially stripped away those messy quadratic residuals, the distracting static, and projected that infinite 3D nightmare straight down into a clean, highly effective, and most importantly, solvable 2D puzzle. That leads us nicely into Section 4, the two-part solution. By applying that really clean projection, the researchers unlocked a dynamic, dual-strategy investment rule. It tells the insurer exactly how to split their money into two very specific buckets if they want to survive. The first bucket is the myopic component. Now, don't let the word myopic throw you off. It basically just means it's focused on the here and now. This is the profit-seeking bucket. It looks at the current market and essentially asks, where can I get the absolute best expected return for my risk today? It's that classic mean variance demand that keeps the surplus growing. Then we have the second bucket, which is the intertemporal hedging component. Think of this as the protection bucket. Remember those wildly bouncing interest rates from that rubber band chart earlier? Well, this bucket specifically calculates how to shield the surplus from those unpredictable, stochastic changes in the interest rate environment. It acts as an intertemporal shield, anticipating and totally neutralizing market volatility before it can ever damage the capital. Now, this right here, this is exactly what an actuary's wild Friday night looks like. Jokes aside, this 3D surface chart from the research is actually pretty beautiful. It maps out the projected investment strategy. Notice how the whole surface tilts and slopes. That proves the optimal strategy isn't just some flat, static rule. It dynamically adapts. As the short-term interest rate changes along that bottom axis, the allocation strategy actively shifts to perfectly balance that profit-seeking bucket and the protection bucket.
Section 5. Proof in the numbers. Okay, so does this elegant math actually hold up when a real disaster strikes? Well, check out this number, 19.5%. In the researchers' rigorous 10-year simulation, where the insurer is facing continuous market volatility and sudden massive claims, the probability of them facing ruin, like totally going broke, plummets to just 19.5% when they use this dynamic, projected strategy. If they just used a basic, constant investment policy, the risk of ruin was a terrifying 42.5%. This math literally cuts the chance of failure by more than half. No way you can argue with that.
You can actually see the survival in action through these surplus trajectories. That jagged blue line, that is the constant policy. You can see how violently it drops when disaster strikes, eventually just crashing right below zero, which means ruin. But look at the red dash line. That's our dynamic, projected strategy. When those exact same sudden claims hit, the red line is just vastly smoother. It absorbs the shock, it adapts, and it stays safely afloat. And the numbers just cement the victory. Not only does the projected strategy drastically reduce the probability of ruin down to that 19.5%, but it also leaves the insurer with more than double the expected terminal surplus compared to the constant strategy. We're talking 0.72 versus 0.35. They take on far less risk, and they end up with way more capital. It is an absolute win-win. Finally, Section 6. Why this matters. Bringing all this intense calculus back down to earth for a second, the authors stated absolutely perfectly in the paper. They say, the results highlight the importance of jointly modeling stochastic interest rates and insurance liability risk. What that means in plain, everyday English is that an insurer cannot just look at the stock market and they cannot just look at natural disasters. Ignoring either the market's volatility or the sudden surge of claims is a total recipe for disaster. They absolutely 100% must be managed together dynamically at the exact same time. If you've ever bought home insurance, auto insurance, or life insurance, this exact type of modeling is what matters to you. This math is what smooths out the massive financial bumps in the global economy. It prevents those fatal downward surplus movements we saw in that blue line. Ultimately, this complex, clean mathematical projection is the invisible architecture that guarantees the money is actually sitting right there in the bank when your roof caves in or your car gets totaled. So, I'm going to leave you with this to think about. Is your safety net mathematically secure? Next time you pay an insurance premium, remember, you aren't just buying a piece of paper. You're buying into a brilliantly designed, mathematically hardened shield that constantly adapts to the absolute chaos of the world just to keep you safe. Thank you so much for joining me for this explainer, and I really encourage you to look deeper into the fascinating world of actuarial science. It's quite literally the math that holds the world together.